Hey everyone, and welcome back. Today we're going to be looking at some fascinating data about how stocks and mutual funds have performed in India. I think a lot of us are always trying to figure out the best ways to grow our wealth, and this deep dive is going to reveal some pretty surprising insights.
Yeah, we'll be using a presentation by Vijay Mantri called Bruised Blue Chips and Worst Equity MFs. It's from January 2025, so it's fairly recent data.
And what really struck me is how this presentation challenges some of those common assumptions about investing, especially when it comes to those big, well-known companies we often call blue chip stocks.
Yeah, we often think of those blue chip companies as the safe bets, right? They're the ones that are supposed to perform well in the market. But Mantri's data highlights some unexpected underperformance by those big names. And this is over various time frames, too, from 1 year to 10 years. Yeah. For example, IndusInd Bank, that's a pretty well-known name, right? Well, their value dropped by almost 41% in just 1 year. And even Asian Paints, they've been a market favorite for a long time, but they actually struggled with a negative KGR of 7% over 3 years.
And just to clarify for our listeners, CAGR is basically a way to measure the average annual growth rate of an investment. And that takes into account the compounding effect over time.
So it gives you a clearer picture of the overall growth trend and kind of smooths out any bumps along the way. But looking at these blue chips, it makes you wonder, what could be causing these unexpected results? These are big companies.
Well, it just goes to show that even those well-established companies aren't immune to, the ups and downs of the market. There's so many factors at play, like economic shifts, sector-specific challenges, even just company-specific issues. All of these things can impact a stock's performance. Think about how unpredictable things have been in recent years with global events. That definitely had an impact.
Absolutely. And that makes me think, have you noticed any similar trends in your own portfolio? Are there any companies that you follow that have experienced something similar?
Yeah, it's a good reminder to check in on how your investments are performing, within the broader market context. But here's where things get really interesting. Mantri's data shows that even the worst-performing mutual funds in India, across various categories, often did better than those struggling blue chips.
Wait, hold on, sir. You're saying the worst mutual funds did better than those supposedly stable blue chip stocks? That doesn't sound right.
It does sound kind of counterintuitive, but that's what the data suggests. For example, the average one-year return for the bottom 10 large-cap mutual funds was over 16%. Compare that to the negative returns we saw for individual blue chips, and it really makes you think. And even more dramatically, the worst small-cap funds delivered a CAGR of 28.55% over 5 years.
That's a huge difference, so there must be something else going on here. Why would mutual funds, even the worst ones, outperform these big blue chip stocks?
One key factor is diversification. Mutual funds spread your investment across a basket of stocks instead of just concentrating it in a single company. And that diversification helps cushion the blow when some stocks underperform. Because, others in the fund might be doing well.
So it's like a safety net. It prevents your entire investment from being wiped out if one or two stocks perform poorly.
Exactly. And on top of that, there's the professional management aspect. These funds are managed by experts who are constantly analyzing market trends and adjusting the portfolio. And that active management can make a huge difference, especially if you don't have the time or the expertise to manage your own stock portfolio.
That makes sense. It's not just about picking the right stock, that's about actively managing your investments and navigating those market ups and downs. It seems like diversifying and having a professional at the helm can be a powerful combination.
Right, and this leads us to the core of Vijay Mantri's message: the importance of long-term investing and the power of compounding. And this applies to investors everywhere, not just in India.
Compounding, that concept everyone talks about, the eighth wonder of the world, right? So how does Mantri demonstrate this in his presentation?
He uses a case study, the HDFC FlexiCap Fund. He tracks its growth over various periods, 3, 5, 10, 15, 20, and even 30 years. And what's fascinating is that the rate of growth accelerates as the time frame expands. He calls it incremental growth.
So the longer you stay invested, the more your returns build upon themselves, leading to that, exponential growth.
Exactly. Think of it like a snowball rolling downhill. The longer it rolls, the bigger it gets. It gathers more and more snow as it goes. That's compounding.
That's a great analogy, but the specific example is from India, but this principle is universal, right?
Absolutely. Even if you're not in India, the lesson is the same. Even small, consistent contributions invested over the long term can grow significantly thanks to that compounding effect. So think about your own financial goals and how even small, regular investments can make a big difference over time.
That's a really important point. It's not always about having a massive lump sum to invest. Consistent long-term contributions can be just as impactful, especially when you consider compounding.
Precisely. Now, speaking of consistent contributions, Montree also talks about the power of SIPs, systematic investment plans, which are really popular in India.
Okay, I've heard of SIPs, but I'm not really sure how they work. Can you explain it for our listeners? How can they benefit from this approach?
Sure. Imagine setting your investment on autopilot. That's basically what an SIP does. You invest a fixed amount of money at regular intervals, usually monthly, into a chosen mutual fund.
So it's like automating your savings and investments. You're taking the guesswork out of timing the market.
Exactly. And this disciplined approach helps you ride out market volatility and benefit from rupee cost averaging.
Rupee cost averaging. I've heard that term before, but I've never really understood it. What is that? How does it work?
Okay, so think of it this way. When the market is down and prices are lower, you're buying more units of a mutual fund. And when the market is up and prices are higher, you buy fewer units. Over time, this averages out your purchase cost, and you could potentially get better returns in the long run.
So instead of trying to figure out the absolute perfect time to buy, you're basically investing consistently regardless of whether the market's up or down. Kind of like getting a discount when the market dips.
Exactly. And Montree uses a great example. He shows how a 10,000 rupee monthly SIP into that HDFC FlexiCap fund would perform over different time periods.
Okay, let's talk numbers. What does that growth look like?
Well, after just 3 years, a 3.6 lakh investment grows to 5.18 lakhs. By year 5, a 6 lakh investment would grow to 11.66 lakhs.
That's really significant growth in a relatively short time. But what if you stretch that time horizon even further?
Well, after 20 years, a 24 lakh investment would become an incredible 161.09 lakhs.
Wow. That's amazing. It really shows you the power of staying invested for the long term. But I think what's even more interesting is how Montree breaks down the portfolio composition over time.
Well, you're right. What he points out is that over time, the gains portion of your portfolio actually starts to overtake your initial investment. It becomes the dominant part of your holdings. It's like a visual of how compounding really kicks in and snowballs over time.
So the longer you stay invested, the more your gains are working for you and generating even more gains. It's like this chain reaction of growth.
Precisely. And that's a strong argument for starting your investment journey as early as possible. Even if you can only invest small amounts at first, the power of compounding can do wonders over time.
Yeah, it really highlights the importance of patience and discipline, right? Just sticking with your investments instead of trying to chase quick returns or time the market perfectly.
Absolutely. And these benefits aren't limited to the HDFC FlexiCap Fund. SPs, in general, offer this structured and relatively low-risk way to participate in the growth of the market, especially over the long term.
This really aligns with Montree's message about creating that investment framework.
Right. He emphasizes diversifying your portfolio, involving your family in the process, and making informed decisions together.
So it's about having a plan and understanding the risks and rewards and staying committed to your long-term financial goals as a family.
Exactly. And while Montree's presentation focuses on India, these principles are really universal. Patience diversification and a long-term perspective are valuable for investors everywhere.
This has been a fascinating look at how stocks and mutual funds have performed in India, especially with those insights from Vijay Mantre's presentation.
Yeah, and we saw that even those considered to be safe bets, those blue chip stocks, can face challenges. But the potential of mutual funds, particularly through SIPs, really stands out when you're looking at long-term wealth creation.
We'll be back in part 2 to explore even more insights from Mantre's presentation, including some fascinating case studies that highlight the importance of patience and resilience in the face of market fluctuations. So stay tuned. Welcome back, everyone. We're continuing our deep dive into Vijay Mantre's presentation on Indian investments. And this time we're going to focus on something I think a lot of investors worry about: market downturns.
It's true. Market volatility can be really unsettling, even for experienced investors. But Montree uses a specific example, the Taurus Infrastructure Fund, to show how those who stay invested during those tough times, they can actually come out ahead.
Okay, I'm intrigued. Taurus Infrastructure Fund, I'm not really familiar with that one. What makes this fund stand out?
Well, imagine this. You started investing in this fund in January of 2008, right before the global financial crisis hit. Things might have seemed good at first, but then the market crashes, and the fund's NAV plummets. By December 2008, your investment would have lost almost half its value.
Oh, wow. Yeah, I remember those days. My portfolio definitely took a hit, too. And I was so tempted to just sell everything. But thankfully I held on. But I can only imagine how scary that must have been for someone who had, just started investing.
Absolutely. It's a natural reaction, right? You want to pull your money out when you see it losing value so quickly. But here's where the story gets interesting. Montrie's data shows that if you had held on to that investment in the Taurus Infrastructure Fund, even after that initial drop, things would look completely different today.
So those who panicked and sold at a loss, they actually missed out on the rebound.
Exactly. By October 2024, just 16 years after that initial investment, the Taurus Infrastructure Fund generated a return of over 346%. So the people who weathered the storm, who didn't let that short-term volatility derail their long-term goals, they reaped the rewards.
That's an incredible turnaround. It really shows you that, that saying time in the market is more important than timing the market. Because trying to predict the perfect time to buy or sell, well, that's almost impossible, even for, seasoned professionals.
Yeah, it really is. And this principle applies not just to, sectors like infrastructure, but to the market as a whole. There will always be periods of growth and decline, times of optimism and fear. But, as Volatility emphasizes, it's that ability to stay disciplined, to stay focused on your long-term goals. That's what often leads to success.
So for those listening who might be worried about market downturns, what are some key takeaways they can apply to their own investment decisions?
Well, first and foremost, it's crucial to, define your investment goals and really understand your own risk tolerance. If you're investing for the long term, you should see those short-term fluctuations as opportunities to buy, not as a signal to panic and sell.
That's easier said than done, though, right? Especially when you see your numbers dropping. You start to worry about losing your hard-earned money.
It's true. Having a clear investment strategy and, maybe even more importantly, the discipline to stick to it can make all the difference. And it's also helpful to remember that market downturns, they're normal. They're a natural part of the economic cycle. Historically, markets have always recovered. And the people who stay invested, well, they often benefit from that subsequent growth.
This kind of goes back to Montrie's point about involving your family in the investing process. If everyone understands the plan, the risks involved, and that long-term vision, it can help everyone stay on track, even when things get, a little rocky.
Exactly. It's about making informed decisions together, not emotional ones. And speaking of, managing risk, diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, even geographic regions. That way you're reducing your exposure to any single risk.
It's like building a well-rounded portfolio, just like you would build a balanced diet or a fitness routine with a variety of exercises. You don't want to be overly reliant on any one thing.
Exactly. Now, let's move on to another interesting concept Montrie brings up in his presentation. He talks about the difference between accumulating more units versus aiming for a higher NAV.
Okay, this sounds intriguing. More units versus a higher NAV. Can you break that down for us?
Sure. So it's really about understanding how investing in mutual funds works. Montrie's data, and this spans from 1995 to 2025, shows that the NAV of the HDFC FlexiCap Fund, for example, it fluctuated a lot over time. There were times when the NAV was lower, so you could buy more units for a given amount, and then times when it was higher, so you'd get fewer units for the same investment.
It's like when you're grocery shopping. Sometimes you get more for your money because things are on sale, and sometimes you get less because the prices have gone up.
That's a great analogy. And that's where the beauty of SIPs comes in. Remember those regular automated investments we were talking about? With SIPs, you're automatically buying more units when that NAV is lower and fewer when it's higher. So you're effectively averaging out your purchase cost over time.
Ah, so that's rupee cost averaging in action again.
Precisely. And what Montrie's data suggests is that over the long run, this approach of just steadily accumulating units, regardless of those NAV fluctuations, can be a really effective strategy.
So instead of trying to, perfectly time your investments, you're just staying consistent and trusting in that process of rupee cost averaging.
Exactly. It's about steadily building wealth, brick by brick, not trying to hit a home run with every single investment.
I appreciate how Montrie's presentation just keeps emphasizing these fundamental principles of investing. It's not about getting rich quick or outsmarting the market. It's about building a solid foundation based on patience, discipline, and a long-term perspective.
Absolutely. And these principles apply to everyone, regardless of, their financial situation or their investing experience.
That's a great point. Whether you're just starting out or you've been investing for years, these ideas can help you make better decisions and, potentially reach those financial goals.
Now, before we wrap up this part of our deep dive, let's switch gears again. And look at another interesting thing that Mantri highlights in his presentation. He spends a good amount of time emphasizing the power of compounding, especially over extended periods. And he uses the HDFC FlexiCap Fund, again, as an example.
Okay, I'm ready for some more numbers. What does Mantri's data show about the long-term growth of this fund?
He tracks its growth over different time frames, 3 years, 5 years, 10, 15, 20, even 30 years. And it's amazing how the rate of growth just accelerates as the time frame gets longer.
So it's like that snowball effect we were talking about. The longer you let your investments roll, the bigger they get. That compounding, right?
Exactly. And Mantri illustrates this with his concept of incremental growth. For example, over a 3-year period, the HDFC FlexiCap Fund grew 1.91 times, but over 20 years, that growth jumped to an amazing 28.27 times.
Wow, that really is the power of compounding in action. It's almost magical how those returns start to build on themselves over time.
It really is. And here's another interesting thing. The incremental growth between years 15 and 20, that was 20 times. But between years 10 and 15, it was only 4 times. So you can see how the power of compounding really starts to take off as time goes on.
So starting early and staying invested for the long haul can make a huge difference in, really maximizing your returns.
Absolutely. And this is important for investors of all ages, but especially for those who are just starting out. The sooner you start using the power of compounding, the better.
You got to start building that snowball early and watch it grow.
Exactly. Even small, consistent contributions can make a big difference over time because of compounding.
I'm really impressed with how Vijay Mantri uses real data and clear explanations to bring these investing principles to life.
Me too. And as we continue our deep dive in Part 3, we'll explore more of his insights into market trends, investment strategies, and the keys to, long-term financial success.
So stay tuned for Part 3, where we'll take a closer look at Mantri's analysis of SIP performance. And we'll uncover some valuable lessons for investors looking to build a secure financial future.
Welcome back to our deep dive. We've been spending time with Vijay Mantri's presentation on Indian investments. And in this final part, we're going to really zoom in on one of the most, popular investment methods in India, SIPs. Systematic investment plans. I know we've touched on them throughout this whole deep dive, but let's unpack what makes them so effective, especially for long-term growth.
Yeah, one thing that I think is really cool about SIPs is that they kind of take the emotion out of investing, because instead of trying to, time the market perfectly, which, let's be honest, it's super hard to do consistently, you just invest a fixed amount at regular intervals, regardless of what the market is doing. Yeah, you're basically putting your financial goals on autopilot. You just decide, okay, this is the amount, this is how often, and then you just, let the system do its thing. Now, Mantri, he really goes deep on SIP performance in his presentation. He uses the HDFC FlexiCap Fund as a key example. So what did he find?
So he looked at a hypothetical 10,000 rupee monthly SIP into this fund, and he looked at different time frames. So like 3 years, 5, 10, 15, and 20 years. And the results are honestly pretty amazing.
Okay, I'm always up for some inspiring numbers. What kind of growth are we talking here?
Well, after just 3 years, so a 3.6 lakh rupee investment would have become 5.18 lakhs. So that's a pretty decent return in a relatively short amount of time.
Yeah, that's pretty impressive. But I imagine the real magic happens when you stretch out that time frame, right? Like compounding really kicks in.
Exactly. So by year 5, a 6 lakh investment, that would grown to 11.66 lakhs. And get this, after 20 years, a 24 lakh investment, it would have turned into a massive 161.09 lakhs.
Wow. That's incredible growth. It really shows you how, consistency and time, they're your biggest allies in the investment world. You don't need to, make those huge lump sum investments. Steady, disciplined contributions over time, combined with that power of compounding, can lead to, some serious wealth.
Absolutely. And what I think is really cool is how Mantri, he breaks down the portfolio composition over time, and he shows how the gains portion of the portfolio, it gradually starts to overtake that initial investment. So it becomes the dominant driver of the growth.
It's like a visual representation of that snowball effect we were talking about.
Exactly. It just highlights that power of long-term investing with SEPs.
And while those numbers are, they're specific to that HDFC FlexiCap Fund, the underlying principles, they apply to SIPs, in general, right?
Oh, yeah, absolutely. So SIPs in general, they offer this structured and kind of low-risk way to tap into, like, the growth potential of the market. So they're a really good option, if you're looking for that disciplined, hands-off approach to building wealth over time.
It all comes back to, Vijay Mantri's core message: create that solid investment framework, diversify your portfolio, get your family involved.
Yeah, it's about working together, making informed decisions, understanding those risks, and, just staying focused on those long-term goals.
So after spending all this time with Vijay Mantri's presentation and looking at all this data, has your perspective on, stock picking versus investing in mutual funds changed at all? And how do you see yourself applying, these principles of long-term investing and compounding to your own financial goals?
Well, I think the most important thing to remember is that knowledge is only valuable when we actually put it into practice. So we really encourage you to explore these ideas further. Do your own research. Think about how you can use the power of long-term investing to reach your financial goals.
And be sure to check out our website, our social media for more information and conversations on personal finance and investing. Thanks for joining us for the deep dive.